Welcome to Black Letter Money. It's not a conspiracy. It's not a secret. It's written directly into the tax code, available for anyone to read. Some of the wealthiest Americans routinely pay lower effective tax rate than most middle-class workers, and it's completely legal. Today, I'm going to show you exactly how. In this video, we're going to cover three mechanisms: capital gain rates, the carried interest provision, and the step-up in basis at death. Together, these explain how people with tens of millions of dollars legally pay lower effective tax rate than people earning $80,000 a year. This is not opinion, this is actual tax code, and understanding it matters whether you have money in the market or not. If you earn a salary, you pay income tax rates. In 2025, those rates run from 10% at the low end up to 37% at the top. Someone earning $80,000 a year as a single filer pays a 22% federal rate on a portion of that income. Their money is taxed the moment they earn it. Now here's where it is different. If you make money by selling an investment you've held for more than 1 year, you pay long-term capital gain rates instead. Those rates are 0%, 15%, or 20%, depending on your total income. For most people with investment gains, the rate is 15%. For the highest earners, above $533,000 for a single filer, it makes out at 20%. Even at the top, there's an additional 3.8% net investment income tax that applies, bringing the maximum effective rate to 23.8%. So the math looks like this. An employee earning $80,000 in wages pays 22% on a chunk of that income. A wealthy investor with $80,000 in long-term investment gains likely pays 15%. Same dollar amount, lower rate. The difference is where the money came from. Many wealthy individuals don't live on salaries. They live on investment returns. A billionaire who holds stock, sells it after a year, pays at most 23.8% on those gains. Their assistant, on the other hand, earning a salary, may pay 22% or more on their income, and unlike the billionaire, they don't get to choose when they're taxed. The system taxes wealth accumulation at a lower rate than it taxes labor. That's not a bug, it's part of the design. Carried interest is how private equity managers, hedge fund managers, and venture capital managers are compensated. Instead of receiving a salary for managing billions of dollars of other people's money, they receive a share of the fund's profit, typically 20%. Under current tax law, that compensation is treated as capital gains, not ordinary income. So a private equity manager who earns millions running a fund pays capital gain rates on that income, even though it is technically their wages for services rendered. So technically, the maximum rate would then be 23.8% compared to the up to 40.8% if it were treated as ordinary income, including self-employment taxes. That difference on the millions of dollars they make is substantial. There is one more important detail here. The Tax Cuts and Jobs Act of 2017 added a requirement that investments must be held for at least 3 years, not just 1 year, for the carried interest rate to qualify for the capital gains rate. That was partial reform, but the loophole itself survived. And as of July 2025, when President Trump signed the One Big Beautiful Bill into law, carried interest was specifically left intact. It remains in the code despite being a target of tax reform for nearly 2 decades from both parties. The third is step up in basis at death. This is the most powerful and least understood of the three. And unlike the others, it doesn't require you to be a fund manager. It applies to anyone with appreciated assets, like stocks or real estate. Here's how it works. When you sell an asset, you pay capital gains tax on the difference between what you paid for it, your cost basis, and what you sold it for. That's the gain. But when you inherit an asset, something different happens. Internal Revenue Code Section 1014, the cost basis of inherited property is stepped up to its fair market value on the date of the original owner's death. All of the capital gains that were accumulated during that person's lifetime simply disappear for tax purposes. Let me give you a concrete example. Let's say a grandparent buys stock for $100,000. Over 40 years, it grows to $10 million. They pass. Their heir inherits the stock with a step-up basis of $10 million. If the heir sells immediately, they owe zero capital gains tax on $9.9 million. The appreciation was never taxed, not during the grandparent's lifetime and not in the time of the inheritance. This is how multi-generational wealth compounds largely tax-free. Two important factors. First, this does not apply to retirement accounts. IRAs, 401s, and annuities do not receive step-up basis. Those accounts are subject to ordinary income tax when distributions are taken by the heir. The step-up applies to assets held in regular, taxable brokerage accounts, real estate, and business interests. Second, in community property states, when one spouse dies, both halves of jointly held community property can receive a step-up in basis. This is a significantly larger benefit than the rules in most other states. Understanding these three mechanisms matters whether you have $1,000 invested or $10 million. And here's why. First, if you invest, even modestly, you can access the same favored capital gain rates that the wealthy rely on. Holding an investment for more than 1 year before selling is one of the most straightforward legal tax advantages available to any investor. That's 15% rate instead of 22 or 24%. That's not just for billionaires. It applies to anyone with taxable investment gains. Second, the step-up basis is something every family with appreciated assets should factor into their estate planning. The decision of when to sell, whether to hold until death, or how to structure an inheritance can have enormous tax consequences. Talk to a tax professional if you have significant appreciated assets. And third, when you hear debates about tax fairness, you now understand the structure behind it. The conversation is not about illegal tax evasion. It's about design choices written directly into the code. Choices that can be read, understood, and to be used by anyone who knows they exist. If this is the kind of thing you wish someone had explained to you sooner, there's a lot more where this came from. Subscribe to Black Letter Money. This is what we do here. The law and the money. Together, explained clearly. I'll see you on the next one.